As the year draws to close, trading volumes have begun to taper off. However, investors remain focused on potential interest rate moves by the Fed Reserve. While the Fed's decision to hold trade steady in January is unlikely to surprise the market, the pace and the timing of future rate cuts are far less certain. Forecasts currently suggest that the Fed could cut interest rates by 0.5% or even 0.35% in 2025. With these hawkish expectations, the US dollar has risen to a two-year high and is on a track to close December with a 2% gain. On Thursday, the US dollar index kicked off the day at around 108.20. The dollar was also supported by President Joe Biden's approval of a new funding bill passed by Congress. This pushed the threat of another US government shutdown to March 2025, meaning the next round of government funding debates will be a challenge for Donald Trump. It will also serve as a test for both the new leader and the US dollar. One of the biggest sources of uncertainty for global markets will be the implementation of the newly elected president's campaign promises. Looking at the last year's US trade balance figures, the direction of Donald Trump's threats becomes clear. The chart shows the top 10 countries with which the US recorded a negative trade balance, where the US bought more than it sold, destabilizing those countries' economies. At least that seems to be the way Donald Trump sees it. If he moves quickly to implement his tariff hike plans, the currencies of Canada and the European Union, which are part of the US dollar basket, could suffer nearly heavy losses. Does this mean that the euro-dollar pair could reach parity? If everything goes according to Trump's plan, this scenario is quite possible. In fact, analysts even predicted that the exchange rate could fall to around 0.98 euros per dollar. For now, however, given the prevailing market sentiment, selling the euro on a rally in the pair seems more attractive. On the other hand, it's unlikely that Donald Trump will follow through with all of his campaign promises. Many of his statements have already been priced in by market participants. The threat of a higher tariffs may just serve as a negotiation tool. In reality, the situation could turn out quite differently than expected. The Fed Reserve may continue to lower interest rates, while the European Central Bank may pause its monetary easing. As a result, the euro-dollar pair could rise to the technical resistance level of 1.0720 as a part of a bullish correction. And for now, the technical outlook suggests that the euro will remain on a downward trajectory toward the end of the year. Overall, analysts expect the euro to lose nearly 6% against the dollar over the year. And today, the European currency has already fallen below the 1.04 round level, with the nearest support and resistance levels now at the 1.0330 and the 1.0410, respectively. Another key target in the Donald Trump's trade war is China. During his previous presidential term, he made it clear that he wanted to curb any notion that China's economy could surpass the United States. Although China is farther than ever from this competition on the last decade, Trump is not one to miss an opportunity. Just a few weeks ago, he threatened BRICS nations with 100% tariffs if they introduced their own currency for transactions. While the bloc has voluntarily abandoned this idea, nothing will stop the US president from taking credit for this victory. Meanwhile, as Beijing struggles with the mounting foreign debt and deflation, exacerbated by speculation in the property market, the Chinese yuan has lost 2.8% against the greenback and is on a track for its third consecutive annual decline. In an effort to combat the economic crisis, China's authorities have decided to issue a record 3 trillion yuan in a special treasury bonds next year. As China is a key driver of a global oil demand, news from Beijing has somewhat stimulated a rise in oil prices. In addition, reports of a 3.2 million barrel drawdown in the US crude oil inventories last week have continued to support prices. Concerns over escalating geopolitical risks in Eastern Europe and the Middle East have also provided a lift. The prospect of tightening sanctions against Russia and Iran has played its part as has the ongoing threat from Trump, this time regarding the Panama Canal. As a result, Brent crude traded higher on a Thursday, consolidating in a range of $73.10 to $73.60 per barrel, and is likely to maintain its upside momentum through the end of the week. As for the Russian currency, its exchange rate consolidated around 100 rubles per dollar on Thursday. Considering that the pair was trading near the 104 level earlier in the week, this bullish shift looks quite impressive. However, it's important to note that this month's unified tax payment day fell on Wednesday, December 25. Thus, it's the recent influx of foreign currency that may have contributed to the ruble's bullish run. Nevertheless, analysts forecast that the dollar is unlikely to break above the upper boundary of the 98.80 to 104 range in January. At the same time, there are no clear signs that this trading range will narrow, meaning the pair could remain highly volatile. So you have watched the Forex market news on the InstaForex TV channel. We continue to follow developments in financial markets. Subscribe to our channel and follow news with us. See you!